As it relates to distressed investing, it's the market's there, right? We're right in the middle of another big reset. This is not the first time we've been through this.
Hi, everyone, and welcome to The Landscape. This is George Smith Partners podcast. I'm Evan Kinney, and I'm joined by David Pascal, my co-host. David.
Hello.
We're very excited today to have a very special guest, Mr. Dave Hood. Dave has been a resource, a mentor, a helper, a strategist, just an all-around great guy. He's well known in the industry, and he's just been a pleasure to work with as a friend, I think, as we've started this business and have been growing it. So I just wanted to say thanks to Dave for joining us today. We'll let him talk about his background first here a little bit and introduce what he's working on. And then we're going to dive into a discussion centered and focused around ESG investing and what that means to real estate sponsors and capital providers. So, Dave, let's hear about yourself a little bit.
You got you, Evan. Thank you for the lead in. Happy to help, happy to be affiliated with you guys, happy to chat with you today. So look, by way of background, just briefly, I've been, as my looks will attest to, man, I've been in the business for a long time. I've been in the real estate business for almost 40 years. Crazy. And have been through twists and turns. I've always done that as a principal in the business, both as a hands-on operator developer myself, as a distressed buyer of debt back in the 90s, as a founding partner at Lone Star. I navigated from there through the marketplace, started my own firm in the city, buying and building, renovating office buildings south of Market Street, and then made my way into a role as an allocator later in life, just before the GFC in '05. And it really played more of a role as a capital provider to folks who are looking to invest with a global overlay. And I expanded my web, beyond just real estate alone into infrastructure and real assets, but all as a more broad-based capital provider. So I think through the course of that experience, again, I've seen a lot. It's no wonder that, apparently a lot of people out there know me because I've been around a long time. And I've been blessed to really have had a great career and been a lot of different places. But I think the most recent stop I had in 2011, I actually moved from those roles as an allocator to a seat at Stanford at the management company, where I had all of our private businesses, including real estate amongst private equity and venture, but as a player coach, just given my background. And I had hoped the day I landed there, honestly, that would be it for me. And sadly, things don't always work out the way you'd hoped, but I really had hoped to have just real impact in that seat. And I'd sort of come across this whole concept of double bottom line investing before I got there. And it just spoke to me. I'd spent some time sort of digging around, and I just was sort of encouraged by the prospect of finding things that stood about something other than just making money. So I went out to the advisory board of Sonen Capital at the time. It was friends of mine who were working there. And I figured there's no better way to learn than to see it firsthand and jump in. So that's sort of what led me to Sonen initially in an advisory capacity. And then sadly, when things at Stanford didn't work out, a couple of years later, they reached out and asked if I'd like to take the leap from being an advisor to an employee, spent some time and eventually came full circle. And I think given the blow of having left Stanford, it was sort of a time to repot for me personally. And in many ways, this whole thing around double bottom investing spoke to me for personal reasons. And so I really started to think about agendas personally as much as professionally. And if I find a way to marry those two in the same place, it was a win-win. And so that's what eventually led me to Sonen. I accepted the offer, and I've really been working with them ever since. That was back in 2013. And it really is more than anything to scratch the itch.
So what is Sonen, and give our listeners a bit of a background. What do you guys do?
Yep. So Sonen's a true impact investment firm, which means two things. That we invest in things that are profitable, but we also make no excuses about being capitalists and looking to make money. So we're fiduciaries first and foremost. And our belief is that the things we do succeed because of what we're involved in, both financially and otherwise, not in spite of it. And so the trick for us to sort of find opportunities that sort of meet that goal at the time I started, it was very much of a nascent business. These concepts were mostly housed in what people viewed as tree hugger sort of platforms. But as time's gone on, the world's sort of coming our way on a bunch of different levels, which I'm sure we'll touch on. And so what Sonen does, we invest broadly on a global basis in what would be an endowment style investment platform that invests across all asset classes, public equity, fixed income, special sits and credit, and then on the private side, real estate, natural resources, private equity, and venture. And so I was brought in at Sonen to help them build out their private platform.
Great.
Good.
Very cool. So, David, do you want to kick us off with the question, or you want me to ask the first one? We got two Davids here today. So David Pascal, do you want?
What I would say is it's interesting that you're going across on the investing across a variety of platforms. I'd like to hear a little bit about how real estate fits in right now amongst the other possible asset classes, and also are you investing in distressed debt? And I want to talk to you hear about your experience in the 90s buying distressed debt, and do you feel that opportunity is coming or is here once again? Those are my two questions.
Okay. Okay. I think I could remember all that. So, look, as far as real estate's fit, within the broader context, it's one piece of a much bigger whole. But this is the piece that I bring. That's where I bring my expertise. It's my wheelhouse.
Right.
So it has a place for sure. And I think the good news, especially as time's gone on, is that like I say, the manifestation of those two bottom lines is tricky in all ways, right? Finding things that do good and maybe perform on par with, maybe better than, because of its orientation to these impact concepts, is not an easy thing to find, right? Not surprisingly. But real estate to place, in large part because of its tangibility, far more credible and far more deliverable than you would think on a bunch of different levels, both environmentally, right, in terms of sustainable investing, and socially, right? So for things like affordable housing that become more and more pronounced. So it's sort of always been a piece, but I think within our world, it becomes a more relevant piece as time goes on because of those two things, okay? As it relates to distressed investing, it's the market's there, right? We're right in the middle of another big reset. This is not the first time we've been through this. This was GFC in 2008. It was with the tech bust and boom in 2000. It was the S&L crisis in 94. It was,
Right.
It's been a series of things, right? Sort of every 10 years. This is our penance.
Right.
And so the opportunity is there. And look, what we did at Lone Star, we did as red meat eating capitalists, man. We were out to buy and capitalize and make as much money as we possibly could. Buy it low, sell it high. We did it, right-minded in right of ways, but we had one objective: to make as much damn money as we could. Sonen, because of who we are, stands for sort of this other thing. So, but we got to be attuned to the market. So to the extent the stress is sort of here and present, it's something certainly that people we talk to are aware of and considering. But in some ways, it's where my paths diverge in terms of my background, because we can't sort of come at this as vulture investors, right? Where we're coming in to sort of beat the crap out of the borrower's debt that we're buying. So we have to sort of have this overlay of a kinder, gentler approach. And so in many ways, the folks are sort of approaching distress investing with an impact overlay in real estate right now, is to find ways to help those who need it most, and to find ways to find more consensual, kinder approaches with the underlying borrowers. And so that rather than crushing them and taking the assets, running the risk that you have to take assets back and foreclose and leave them in your dust, it's find ways to help them pick themselves back up off the mat and to create structures that allow them to do that, but still in profitable ways.
Got
Makes
it.
sense.
Got it.
So let me ask you a question there, though. How do you guys define that double bottom line investing as it relates to real estate? I mean, are you focused on finding properties with a certain level of like LEED specification, or are you investing a lot?
Environmental.
Yeah. What's the?
Yeah.
Yeah.
Yeah. Okay. So this will take us around a rabbit hole. So I'll try and keep this concise. But look, remember, we invest on two dimensions. So we're investors first and foremost. So we are true fiduciaries. We raise money with the idea to generate the best risk-adjusted returns we possibly can. And like I say, we believe that we do that because of our in orientation. And there are increasingly more and more compelling reasons why that makes sense in real estate today. So I'll just tick through a few of those quickly, but investors more and more are looking at this. So to the extent you're raising, especially institutional capital, but even high net worth, these are considerations that people are taking into account in their investment decisions. Not universally, but it's coming, and the trend is only growing more pronounced. And I say that despite sort of the pushback from the haters who believe that this is all just a sham, right? So nothing is ever universally true, but the trends, I guarantee to you, are hockey stick like in their trending up. So and so on the impact side, again, it's always been a trickier realm for us because it's amorphous in many ways. There's certain things that you try and measure empirically. This is a place where real estate shines, so I'll touch on it in a minute. But there's many things that are sort of more subjective and less empirical than not. And so you sort of got to make the leap. Some of this requires some common sense. So for Sonen, it's critically important because this is who we are. It's how we differentiate ourselves from the rest of the world. We got to get that right, take it seriously. We go to great lengths to do underlying diligence. We have ways to evaluate. We have all kinds of metrics we use to do that. It's sort of highly customized, probably not worth getting into too much detail on the call. But we're always looking for more, and we find it in a myriad of ways, and no two ways are exactly alike. So it's tricky, right? So, but there are some commonalities, and again, in real estate in particular, the stuff on the sustainable side, sustainability is the easier thing to measure because at the end of the day, it all sort of succeeds or fails based on your ability to track data and to reduce your use of resources, the leading one of which is energy, right? This is the one that everybody's sort of focused around. So if you sort of start from a baseline of measuring how much energy you use in a building today, and you can find ways to overlay means to reduce your energy usage through whatever means possible, right? There are all kinds of different ways. Then you sort of are achieving that goal at some level. And you can use those measures to see how you track and do that. And you do that relative to goals that people will usually will mandate internally. And the one that people are talking a lot about is just net zero goals, right? So net zero in short form is that at the end of the day, that you generate no more energy, no new net energy on a net basis, okay? Today, that goal, so many have issued that commitments with sort of a timetable on how to get there. I don't know how many of them fully realize what it will take to actually get to that without the benefit of the one thing that they need to sort of solve the last mile fix to get to true net zero. And typically those things are either buying offsets or looking to use credits, right? It's an in lieu of solution. So the true ultimate goal is to do that from the property itself. That you find ways to be so good.
Accoutrements, you're saying.
Yeah, well, and it's funny. Some people will even go to the point of not taking that last step because as fiduciaries, they have a hard time making the case that as an investor, that they can justify investing in credits or offsets at the expense of investor returns. Right? They're spending money as a fund that otherwise would go to, capital that would be returned to their investors.
Distributions, yeah.
So look, it's aspirational. But the moves that have been made over the course of the last 3 or 4 years in this regard are they're amazing. They're groundbreaking, and it's common. And look, so beyond the push from investors who are looking, the other thing that we know that's going on is incredible regulatory push, not only on sustainability but on the social side, especially as it relates to affordability, big time. And so there is a little bit of this tug of war, push and pull, right? Where investors sort of pushing. But regulators are literally pulling people there because if you don't step up, you really get to the point where you don't get approvals, right? And it's being taken to extremes that people cannot ignore. Okay, so let me just give you again a quick data point. In England, right, in London in particular, right, highly attuned to these things, and not surprisingly, most of Europe is out ahead of this more than any. And so they have passed standards for the office leasing market in downtown London called it's EPC standards. EPC EPL. I may have the acronym wrong, but effectively what they've set is a deadline sometime in the course of the next 3 or 4 years, where it's that as a landlord, you have to quantify and measure the sustainability of your building. And if you don't comply with standards that continue to have a bar raised on what they are, you literally won't get approval to sign a lease in your building.
Wow.
Sort of a problem on many counts, right? And as it stands today, the stock in the London office market is probably somewhere on the order of between 75 and 85% non-compliant.
Wow, interesting.
So stuff is real, and these trends are, again, only going one way.
So tell me about, like, what benefit, I mean, I understand that the trend's moving in one direction, but like practically speaking, we're in the service of real estate capital markets sponsors. Some of these are institutional folks, some of these are family offices, et cetera. How can we translate this into some practical advice for our sponsors to maybe open up the width, I guess, or the breadth of investors who may be interested in investing with them by virtue of doing things that may help those investors meet their sort of ESG or double bottom line targets.
Yeah. Look, I think more than anything, just to get out ahead of this is the bottom line, but in mindful ways. And the truth is this, as I define it, this is the big challenge of the space. It's not one thing. There's not a clear path. It's a series of things that has no end, by the way. There is no finish line on this stuff, but it goes from doing nothing to doing everything, right? With these sort of concepts in mind. And no one lives in those extremes. Anybody in the real estate business, honestly, is doing something that sort of could comply with sustainability. So, but most of those folks have gone there just by virtue of just expediency, right? Just good business, right? Which is honestly, that's the dream in all of this, is for this to just be good business practices, not to be impact investing or not. But I think that everybody should take the time to proactively have a conversation and thoughtfully decide where on that spectrum they want to sit.
Yep.
Knowing what's at stake, right? So, again, investors, if they're out raising institutional capital, you can expect that some subset of those people are going to ask what they're doing. And the question at that point is, they got to have an answer. If they don't, then they're toast. They're going somewhere else. And so, but again, it's not black or white. It's not something or anything. You need to sort of be mindful enough of what these investors are looking for to know how much on that spectrum you should choose to do. It should be an elective decision that you all make. And like I say, you can sort of adjust on the fly, but I think that to me is the single best thing that these folks can do for themselves, because look, the other risk, so I told you, it's investors, it's regulators. We know that it's coming there. And by the way, the other thing that's happening is just due, by virtue of climate change, is that, remember, financial performance is much about risk as it is return.
Right.
Well, do you think that we stand any risk based on climatic effects on the buildings we own? Fires, flooding, tornadoes, right? Real estate is front and center. And by the way, even if you don't think, you're remiss from that you're protected, the insurance companies don't think that. And so all of a sudden you need to go out and go insure your building. We know that the insurance companies have literally redlined certain states outright. And if you can't insure your property, right, bad enough, you don't get a loan. You can't finance it.
And you can't get equity.
You can't get equity if you can't finance it, right? There's a huge trickle down. So again, I think at the end of the day, you just got to understand what the real rationale is from a business standpoint only. Period. End of story, right? The fact that there are nobler ideals that sort of these things may represent, it's great for those who care, but should not ever be the lead sort of driver for people to consider this, other than those who care enough for it to matter. But this is all just good business, man. And like I say, the trends only continue to get more pronounced. Climate change ain't going away, right? These things are only becoming more pronounced, not less. So I suggest that people sort of step back and evaluate where they are as a business, plain and simple. And again, the sustainable front's easier because it's measurable.
Right.
But at some level, you got to think about this on the social front too. Again, are there issues around the lack of affordable housing that perplex us all as real estate investors? Does that have an effect overall on the business? The answer is hell yes, right?
Yeah, but I'd like to push back on that one a little bit. How much of affordable housing do you think is driven, like the affordable housing crisis, like if you pick up a city like, for example, Los Angeles or San Francisco, where regulation has gotten completely out of hand, in my humble opinion, and it's added a tremendous amount of cost to the entitlement process by virtue not only of regulatory hurdles to jump through to fulfill these, these grand visions and things that people have, like what you're describing, but also with respect to capital, because time is money. And if you have to spend a lot of time, particularly with, deposits out or et cetera, or even owning land through an entitlement process, if you're building something, not to mention sort of the regulatory hoops to jump through, particularly when trying to source, maybe it's, certain building products that are going to be more compliant with what you're suggesting here, that adds a tremendous amount of cost. And it's sort of potentially like an inverse or perverse incentive program if you're really trying to create affordable housing and solve the need, right? So, this is my one pushback.
How do you walk that tightrope?
What's that?
No. How do you walk that tightrope, basically, right? Sort of to deliver on the goods, but not do it at the peril of the financial outcomes, basically, right?
Well, no, I think that in some cases, in many cases, from what I've seen, the added regulatory hurdles and burden and considerations are, in fact, potentially part of the reason why there is, a housing shortage. So, and if we're talking about wanting to provide housing at a lower cost and create, a social impact in that way.
Well, because regulators overlay enough economic burdens that people just choose not to invest, right? And so therefore no housing's built.
And therefore housing
it's a legitimate point. Yeah, it's a legitimate point. And so on the one hand, in a perfect world, regulators would sort of have a more engaged conversation with the folks who are delivering on the flip side to find middle ground that works, right? So this has like been the challenge in New York City. New York is on its ass right now because Cuomo effectively pulled the carpet out from beneath New York City on the rent restrictions that they had sort of renewed every 3 or 4 years. Sadly, 6 months before COVID hit, right? And so some part of what's knocked that city on its ass is it's a triple whammy, right? It was changing rent restriction laws, COVID, and now the credit market's going up, upside down. So, and like you say, the outcome's going to be that all the things they're trying to solve for, it's not going to happen, right? They can put all kinds of rent restrictions they want in place. It's going to penalize the folks who own it already, because that you can't sort of get away from. But there's going to be no new capital that comes in, and even money that would go into those properties to improve them, right, to make them more livable. If it makes no economic sense, you can't require somebody to put money back into a building without giving them the benefits from upside. So in a perfect world, there's more of a conversation to find middle ground. So I think, and then the second thing I'd say, Evan, is that as much as that's true, the one thing that every investor has at its disposal is the benefit of options and choice. Nobody has to do anything. So I'm just telling you that, and the concept of affordability can take many different shapes. And so as investors, people got to sort of factor all these things in and to accept some of these things in givens and make a decision for themselves. If they think in totality, including whatever burdens there are of the capital they got to spend, the rent restrictions they've got, is there still a path to making good risk-adjusted returns? And I can tell you that there are increasingly more and more platforms who are figuring out that game in both debt and equity.
When you're raising capital from your LPs, can you give us a little bit of a sense of what the pitch is, and also if an LP is looking at Sonen as an allocator that they want to invest with, et cetera, how are they looking at you as a percentage of their overall portfolio? Are you guys? I just walk me through that a little bit. Like, how do they think about trying to integrate what you offer into their overall mandates?
Yeah. Well, so look, Sonen lives out on the extreme of that spectrum I described earlier, right? Because we are sort of a committed impact investment firm, right. We have those double bottom line checks. So we live sort of farther down that spectrum. And so generally people who find their way to us know that going in, and or at least come with that as part of their criteria. But look, investors are like snowflakes. No two are alike. And so it literally depends. And the truth is that you go to the same place with the investors we talk to as anybody else would. And that's to basically, ask questions and listen, listen and learn, right? Because at the end of the day, this all succeeds or fails based on what it is they're looking for and what they're looking to accomplish. Some have greater regard for these things than others. But the one thing that everyone is coming to us is going to be looking for are basically compelling risk-adjusted returns, period, financial investors. So the one thing that I always take pains to do is to lead with the business case on whatever it is they're looking to raise money for. And remember, Sonen does this stuff across all investment classes. So you got to have a really strong conversation with them about what it is they're looking to. And so to your question, some come and want to invest all of their capital in a mission-aligned fashion and believe in our ability to deliver on that. And so they invest all their money across all sort of the traditional asset classes and have us allocate broadly across everything that we do. Some come in and come a la carte, right? Take small bites. So it's all over the map, Evan. I'd say more often than not, it's the more of the latter. But as I said, the more that we can sort of prove the goal, right, of performing on par with or better than, and still doing good, who in the right mind wouldn't do that, right? It's just, again,
Right.
at that point, it just becomes good business. So that's the holy grail. We're a ways from getting there. But at some point, again, the hope is that these won't be bifurcated things. And again, to something that we were talking offline about earlier, to find ways, instead of being divided and at odds about this, let's sort of meet in the middle and find a way to reach consensus, right? On something that just makes good business sense.
Interesting. All right. Well, very good. I think we should probably wrap up our podcast today. Mr. Dave Hood, thank you so much for joining. Mr. Pascal, I'm going to put you on a spot. Where do they find out more about George Smith Partners, and where can people?
They can go to our website, gspartners.com. And on there, I would really urge you to subscribe to our newsletter, FinFacts. It comes out every week. I write a column about interest rates, but more importantly, it describes our recent transactions. So you get to see live market info.
That's great. And of course, you can subscribe to this podcast anywhere: Apple Podcasts, Spotify, etc. And thank you for joining.